When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about what changed this week and what it means for your retirement. We'll also answer listener questions, and then later on in the show, why rebalancing your retirement portfolio matters. My name's Jeff Shade. I'm just here to ask the questions, but the words of wisdom and solid advice, they come from Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson. Jeff, how you doing this weekend?
Doing great. How are you doing?
I am doing fantastic. Thank you. I hope everybody else having a great weekend here. As always, we really appreciate you joining us for Premier Retirement on KNST. Jeff, every week we try to separate the headlines from what really matters to retirees, and some weeks there's not much to talk about, but this week is just a little bit different. We had renewed tensions in the Middle East. Oil prices are moving a little bit higher. Investors are wondering what the Federal Reserve will do next. Another busy earnings season and plenty of headlines that can make retirees nervous. So let's start with the Middle East. Jeff, oil prices jumped after the latest tensions involving Iran. Every time that happens, people start talking about inflation, recession, depression. They go to the worst thing that could happen. Should retirees really be that concerned about what's going on in the Middle East?
Well, I think we all should be concerned about what's going on in the Middle East. I mean, it does impact inflation. The price of oil impacts everything. I mean, it's a big deal. Yeah, I think Trump's been pretty easy on Iran in some cases with the ceasefire. I mean, they opened the Strait of Hormuz, and apparently Iran snuck out about $6 billion worth of oil while the strait was supposedly open, even though they were still causing us fits. You know, going back in and fighting for, I guess, our own peace and safety because they want to kill us with nukes to eventually straighten out the oil issue. I think will all eventually happen. These things aren't always pretty. I think Trump's doing what a lot of presidents should have already done over the last 47 years since they've been telling us they're going to get a nuke and kill us because so much of the oil gets transferred through the Strait of Hormuz. That's a big issue. I think we need to do something about that and quit letting them run it. I don't know if bombing all their cities and just destroying things makes the strait any safer, or maybe we should just sink all their ships. I don't know. Thankfully, I'm not the president. I don't have to make those decisions, but I know that this problem isn't going to go away. And as much as we keep thinking it will be, and when we think it's going to be over, price of oil goes down, and all of a sudden we think, oh, inflation is going to be better in check, everything's good, market goes up. But people aren't really paying attention to what's really driving the market. And I think there's a lot of fake bookkeeping driving the market. Our economy is very stretched. It's very thin. The only thing really that's, as far as an economic indicator that looks like it's getting better is maybe high-end real estate for only people that can buy cash or can afford it, and the stock market because people are totally willing to gamble rather than buy investments, and they're not investing for the long haul. Warren Buffett just said that in a recent article as well. So we'll probably get more into the market type stuff later. But as far as should a retiree worry about it, heck yeah. I mean, everybody should worry about it. It's a problem. Who knows how many terror cells that we have tied to Iran are already here because we've had open borders and lackadaisical security in our foreign relations and just border security. We haven't really been treating our country as a place that we need to protect. We've been treating as maybe too open and too footloose and fancy free. And that might come back to haunt us. I hope not. I think there's always something that we can be concerned about. I always try to wake up and look for all the good and try not to complain or just kind of see things as they are and do the best we can with what we've got. But our clients, compared to the typical retiree who has everything bet in the stock market, which is totally being drummed up by betting, by gambling, not by fundamentals. And I'll share a little bit more about that later. Our clients have guaranteed income. They have security. They have principal protected accounts. They have tax-free income generating accounts through LIRPs and Roth IRAs and things like that. So, you know, if you've dealt with us, you should worry a lot less than if you haven't. You know, I had a client recently come in and say, well, hey, you know, I went to this other guy, these other brokers say, oh, just keep it in the market. You're fine. Look at, you've got a couple $1 million. You'll be fine. You're great. And, you know, they get the warm fuzzies and want to jump in and do business. But what they don't know is what happens when the market goes down 50%. Most of these brokers that are out saying, oh, you're fine, have never been through a market crash before. They've never seen what happens when inflation really takes hold and when markets do end up selling off. And I think the markets just really need a catalyst to reset. And I think it's either the truth comes out on earnings, which I think it may. We're just getting into earnings season right now, and there's a lot more disappointing news than we've had in the past. You can only cook your books so long before you have to reconcile some of the things you did in the past by basically depreciating an asset and expensing it over 5 years while you're declaring all the income from the products you sell immediately as income, but you don't actually declare your expenses as expenses except over time. And then when you have to buy those new products, you have to cough up more money again. And then you have to actually write off the balance of what you didn't write off a few years ago as an expense. And that starts hurting current income and earnings. So yeah, I think the fundamentals that have not existed in the stock market for a while, even though they say there's robust earnings, it's a lot of book cooking, if you ask me, especially in the semiconductors and the GPU, AI data center business. It's been very hyped. And I think it's been overblown and overplayed, just like the dot-com bubble was overblown and overplayed and ended up popping. All we need is a catalyst. All we need is a reason. And I think the Strait of Hormuz and the limits on oil and the inflation that it would cause and this war that seems to be prolonged rather than just a quick in and out type of war. Every time Trump says the war is over, the market seems to believe it and oil goes down and people start buying tech stocks again. I don't know that it's going to be the same this time. They've called his bluff too many times, or he's called their bluff too many times. That it's just not happening. That even though Iran says, oh yeah, we want to negotiate, open the Strait of Hormuz and quit being mean to our ships and let's get some oil out of there. And then they go, oh, just kidding. And then they start causing trouble again. So I think after a while, the boy who cried wolf, the Iranians who keep crying wolf, are not going to be believed anymore. We're just going to say, sorry, it doesn't work anymore like that. And that might be the catalyst to get the market to shake down. I don't know. I think the market's due for a correction. I've said that for a couple of years now. It's been due, actually. While the market's been going up, it's been due for a correction. That doesn't mean it will correct. It'll correct when the market decides to. We're due, long overdue. Most people who haven't been retired more than 10 years have never experienced a crash in retirement. The last one probably 15 years ago since they've actually experienced a crash. So if you've been retired 10 years or so, you probably never even had to deal with it. But as a retirement-focused income and wealth manager, I've seen a few crashes and I've seen the devastation it causes people that have all their money in the risk bucket, and many of them don't recover. The story of Norm is the most prominent one I share all the time, but there's others. There's many people who have come and gone and showed me how well they used to be and how unwell they are now and how scared they are to get back in the market because they've gotten burned and they have to spend their money, and every dollar you spend while the market's down is a dollar that doesn't grow back and never recovers. So volatility is a real deal to retirement planning, and I think we're on the verge of it. If you look at history repeats. We're on the verge of it. So I think the Strait of Hormuz and what's going on, based on your question, all the stuff happening in the news is definitely serious, and maybe the culmination of all these little things may be the catalyst that says, hey, the market's finally going to be out of gas, and maybe it's time to get off the train. We've always had some of our money off the train. Our average client has about 2/3 of their money in things that are principal guaranteed or have very limited risk, and a certain amount of either guaranteed income or predictable income, at least predictable in the standpoint of taxability and things like that as part of a plan. I mean, if the other third or 20% or 40% or 50 or even more, if you can afford more risk, goes down, you need to be in a position where it's not affecting your income, your peace of mind, and your sanity while you try to retire and navigate the waters of retirement in these uncertain times. We've always been in uncertain times. Somebody says, oh, well, these are really uncertain times. Well, when has it been certain? A year ago, we weren't certain the market was going to go up another 20%. Some people say, yes, we were. Some people 3 months ago were certain that gold was going to go to $10,000. Well, it went up to 4, 5. Now it's down in the under 4 now. Silver up to 107. Now it's down to under 60. What's going on there? Nobody knows. We're in uncertain times. What if silver goes back to $30? Well, no big deal if you bought it at 30 and you're only holding it as a backup plan for the world melting down. If it's an investment, you should have sold at 107 or at least sold at 90 when it started reversing course and the trend became obviously down. Again, if you don't want to handle all the guesswork in an uncertain world that we are in every day, then delegate it to us. But I'll tell you what, I'm not going to risk your entire retirement in things that I can't control and things that are as uncertain as the market, in spite of how well it's done over the long haul, in spite of how well it's done over the last year, in spite of how well it's done the last couple of months. Actually, last month or two, it hasn't done that well, but it had a little streak there about end of February, March-ish to April, where it zoomed and been kind of bouncing around since then. But the market has its good days and its bad days, its good weeks and its bad weeks, its good years and its good decades. And it has some bad decades and bad years. You don't want to be relying on that money during those bad times, and there will be bad times coming. If you're going to retire for a few decades expect that you're going to go through some bad times. How are you going to weather those storms? Most people so far that have retired in the last decade or so haven't experienced a storm yet. They don't even know how rocked their world is going to be. I do, because I've been doing this for 40 years. I've seen 4 decades of it, and I've seen 3 or 4 major disruptions in the market and people's income and sanity and peace of mind and financial well-being. And some are unrecoverable and some aren't as unrecoverable. It just kind of depends on the plan. So again, if you're retiring, you're worried about this, maybe you have too much risk. If you're retiring, you're not worried about this, you're probably one of our clients. You shouldn't be worried about it if you're our client. I don't worry about it because, in my opinion, based on 40 years of experience, we've got you set up where your income isn't going to be disrupted. We might have to adjust a little bit for inflation, but what are we going to buy on credit with higher interest? Hopefully you're not in that position where you have to. Are you really going to need a new car this year? Maybe we can wait another year and kind of stretch that out if you don't like the valuations on rising prices. You're probably not in the market to buy a new home, so who cares if real estate's going up? Now we probably care because our kids might want to buy a home. Who cares if interest rates up if we're not borrowing money? Food, gas, yeah, those things are up, but usually if you build a plan, there's buffer. That's what you have the stuff in the market for. And if it just means you can't ride first class, but you can still go on your trip, then still go on your trip. Enjoy Europe when you want to go. But maybe you do it on a little bit lower budget if some of that money at risk is some of your discretionary what if money or planning money. Again, I've elaborated a long time on a very simple question. Should retirees now be worried? Yeah, I think we all need to be worried as a country who's at risk of getting bombed with a nuke. Yeah. Should we be worried that oil's getting disrupted? Well, yeah, it's probably going to make driving our car and traveling to visit our kids and stuff maybe a little bit more expensive. But hopefully we've got a little bit buffer built in our plans to accommodate those things.
As always, Jeff, that is a great perspective. I want to continue this conversation in just a moment. In the meantime, I want to remind our listeners that if you've saved significant assets for your retirement, here's an important question for you. Do you actually have a written plan? Or are you simply hoping that your investments will carry you through retirement? Well, at Premier Retirement, Jeff Vogan here and the team have developed the Premier Retirement Roadmap. It's a comprehensive retirement planning process that looks beyond your investments. Jeff will review your income strategy, your taxes, your risk exposure, Social Security, Medicare, estate planning, and more to help you determine whether you're truly on track for the retirement that you envision. If you would like to schedule a complimentary retirement roadmap consultation with Jeff, not going to cost you a dime, call 520-780-9059. It's 520-780-9059. You can make that call this weekend if you want. Simply leave your name, telephone number. Of course, Shelley will return the call on Monday and set you up with that. Again, no cost, no obligation, no judgment. It's 520-780-9059. Start planning your retirement with confidence, not guesswork. Jeff, I want to continue our conversation here. The Federal Reserve still hasn't begun cutting rates. Is that good or bad for retirees?
Well, it depends. If you're a retiree that is living off of a credit line that has a variable interest, you kind of want interest rates to go down. If you're going to buy things with financing, you want interest rates to go down. If you want the stock market to continue to zoom up and have an excuse to continue to go up, if companies can borrow money at a lower rate, that might fall to the bottom line in some cases, especially in the tech business. Typically it does. But the way they're cooking the books, I don't know if that's even going to solve the problem. I don't know that it hurts retirees that have everything paid off. Honestly, I've really enjoyed these higher interest rates. Caps are higher on the indexed annuities with principal protection that we invest in, so the returns are much higher. They're able to keep up, more than keep up with inflation, whereas before, making 1 or 2% on fixed money when inflation was still 2 or 3, you're actually not even keeping up. Well, now if you can make 4 or 5 safely and inflation can stay under 4, you're actually getting ahead still, even on safe money. So in a way, the safe money is good. It also gives companies like insurance companies and banks and other people the ability to invest at a little higher rate so they can return a little bit more of that money to you as an investor, especially as a saver. It used to be that interest rates were so low that some of the retirees and seniors that probably shouldn't be risking a lot of their money risked it anyway because they couldn't live on a 2% rate of return. Now, fortunately, over the last decade or so, they've been lucky that the market hasn't crashed and hasn't stayed down significantly and hasn't caused them to spend their retirement assets in a down market. So I think luck has favored even the foolish person that had way too much risk. But now when safe money pays as much as it does, and you can keep ahead of inflation and know exactly where your money is, it gives a lot more peace of mind and confidence if you want to invest in safe money products. So I think from that standpoint, it's really helped our business. From the standpoint is we have more people willing to utilize the other buckets that we so often like to do, like the principal protection and indexed annuities, also the LIRPs, the life insurance retirement plans that now the caps are 10.5%, 11%. I just look at a statement when guy was up 14% last year. in something safe in a tax-free environment is really good. We didn't see those kind of gains for a while. They were down because interest rates were lower. And the companies that invest money, if you give them money to invest, they only make the same kind of interest, maybe on an institutional level, maybe a little bit better than you and I can make in safe money. And they have to utilize that creatively in order to enhance those returns. Well, it's a lot easier for the companies to do that right now. So retirement planning is maybe a little easier than it's been in some ways. I think the hardest part about retirement planning right now is, when is this market craziness going to end, and how much should we keep at risk, and how long do we want to stay on the train before it derails? And I'm talking about a market correction. Warren Buffett, as I mentioned earlier, he's almost a 40% cash in Berkshire Hathaway. His investments are down 2.5% year to date. I think that's what I just checked a day or two ago. From a year ago, he's up only a couple. He's certainly not beating the market. He's an investor. He likes fundamentals, and fundamentals are not winning out. They're not even keeping up with inflation right now. Who's winning is the gamblers that are willing to roll the dice and keep on bidding up and betting up stocks that have no earnings, are just guessing their future and pretending that their guidance or that their future earnings are going to be X when we don't know if they are or not. And if they do creative financing, they can make it look like they're on track, but eventually that's all going to come back to haunt them. And Warren Buffett knows that. Smart people know that. Ray Dalio knows that. He's a guy that studied credit clear back to the credit cycle, clear back to the Roman Empire, and says we're at the end of our credit cycle. And that's usually when there is really no stop in a market crash, and not just a market crash, and everything bubble. Smart people have been saying that for a while, and they have been taking evasive action, getting into cash, getting into bonds, getting into things that don't pay anywhere near what the tech sector does. But then again, we get these people, tech sector, just saying buy. Can't remember, there was talking heads on the radio. There was one, I'm not going to say the name, but Kramer, he talked, I think it might have been Netflix. But anyway, he says, oh, Netflix is a buy, you got to buy it. And I don't know, maybe it wasn't Netflix, but he was just so, maybe it was Palantir. But buy this, and over the next week, it goes down 10%. I mean, so you can't listen to just people that are cheerleading the market on TV. I mean, they don't really know what the market makers are doing. The market makers are in charge. And sometimes the market will finally come back and bite the hand that feeds it. And right now, the market makers, in other words, the institutions that are directing the market, seem to be in charge. They've got algorithms helping them out, and they play against the psychology of the Main Street investor, and they win. But eventually the market's going to say, sorry, we can't do this anymore, and bite the hand that feeds it, just like it did in the '08 crash. There are certain people that shorted the market because they knew that it was unsustainable. There are people right now that are not shorting the market. Actually, they are shorting the market. The shorts on the S&P 500 are almost the same as they were right before the dot-com bubble, which means people are betting on the downside more than the upside. So, let's take all those things into consideration. Smart money is being very protective. Interest rates going down would pad the market. To answer your question about interest rates, are they going to go up? Or are they going to go down? Is Worse going to do something about it? I don't think he has to. I think he's fine where it is. It's going to keep inflation a little bit more in check, but it's not going to help the market. I think Trump would probably be on the side of whispering in his ear and saying, hey, lower rates. But Worse seems to be kind of a guy that has his own mind made up, and he's going to be in charge, and he's not supposed to be answering to the whims of the president and the White House, even though many of the past Fed chairmen have done that. I know, I get the feeling that Worse is kind of going to plant his feet and hold his ground. I don't see a rate cut coming anytime soon, not with inflation staring at us in the face like it is and oil being up. But again, I don't think it hurts the retire that's planned well, or the retire that has a good savings account that is willing to plan right now and restructure their assets into income producing assets, locking in those higher rates for the rest of their life, so that when the rates actually do come down, they've got a much better chance of beating the future inflation levels than they do right now. So right now is a great time to plan if you haven't, great time to redo your plans, great time to up or upgrade your plan if you had one a few years ago based on a lower interest rate. There's a lot of things we can do, and we've been doing that for most of our clients, and new clients that come to us say, hey, you do different things than my broker. Can you help me do it the premier way? And we do, and we're able to upgrade situations all day long. These opportunities may not be as good or as healthy looking as they are right now, and I attribute that to a higher, more healthy interest rate environment. Now, you might say healthy interest rate environment, shoot, you have to pay 7% to borrow money on a car. You have to pay 7% if you want to buy a house. Yeah, rent's going up. Yeah, that's probably some of the negatives. So again, if we're talking about retirees, high interest rates are actually beneficial. We're talking about our children and grandchildren who want to buy a house, maybe not so good. Honestly, it's kind of a catch-22 in that realm, but it is what it is. And until interest rates go down, people are just going to have to save and be smarter with their money until they can finally either afford a house or prices come down or interest rates finally come down. I think it eventually will happen. They always do. But right now, I don't foresee it in the near future.
Jeff, I think a lot of people listening to the program certainly recognize that you really understand what's going on in the market and the economy very deeply. And they feel like, well, I don't have enough money to deal with Jeff Vogan. I don't have millions of dollars. Can you comment on that, how much that you really have to expect benefit from dealing with Premier Retirement?
Well, I think you can deal with Premier Retirement with $100,000 and still benefit. But typically, when you're doing comprehensive plans, we typically deal with people that have comprehensive problems, a lot of tax issues, trying not to get into that IRMA bracket. That's the extra money you have to pay on Medicare insurance. Most people that have income needs, if they don't have a pension, they've probably saved a lot in a 401k and want to create income that they can count on and maintain their lifestyle. So I would say our bread and butter clients definitely in the millions, not in the hundreds of thousands, but it doesn't mean you can't have a plan. We'd be happy to have a plan. Some people just need a guaranteed income. If they've got a few $100,000 and need an extra $20,000 a year to make ends meet and can leave $100,000 in the market for rainy days and see if they can turn it into $500,000 before they die so they can leave something to their heirs and still have all the income they need and not worry about it. Maybe that's the approach you take on a smaller estate. If you've got a bigger estate where you have millions of dollars in 401k money and you're going to be pulling out more than $100,000 each year in required minimum distributions when you're in your 70s, or maybe even just pulling it out to live on, you're going to have a tax problem that you might want to deal with. So we really like the tax problems. That's really our focus, which most of the people in our business disclaim. If you read the brochures on any of the big box retail brokerage houses or anybody, they always disclaim tax planning, Social Security planning, all the things that we do and make it kind of on the front of our business. So I think the people that find a good fit here are the people that know they have problems that are not being solved with the typical brokerage house, and they can solve them here. So yeah, we like solving more problems, like solving the tax problem, the investment problem, the income problem, the long-term care, future needs. What if I get sick and need my money for a long-term illness? And how do I create a legacy? My life's work has meant something to me. I've built a business. I built a small fortune here. I want to leave it to somebody or a charity and make somebody better off when I leave and leave my mark on the world, not just spend every last dime. Or maybe you want to spend every last dime. And based on the 4% rule that the stock market makes you live by, you might not be able to have the income over time that you want. So again, I think even though our forte and our niche is really geared to the higher ones, that doesn't mean somebody that doesn't have $1 million. I know I talk about it a lot as an example. It doesn't mean they can't benefit by Premier. We help everybody, and we do not equate your net worth with your self-worth. Everybody's a person. Everybody's done the best they can. And we assume that if you've done the best you can, we're just going to try to tweak it and make it as much better as we can.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about current events, and Jeff, I want to talk to our listeners here for just a moment. As Jeff said, whether you've got $200,000 or you got $2 million, the important question to ask yourself is, do I actually have a written plan, or am I simply hoping that my investments are going to be carrying me through retirement? Well, at Premier Retirement, Jeff here and the team, which includes Taylor Vogan, who specializes in taxes here, have developed the Premier Retirement Roadmap. It's a comprehensive retirement planning process that's going to be looking beyond your investments. Jeff is going to review your income strategy, taxes, risk exposure, Social Security, Medicare, estate planning, and more to help you determine whether you're truly on track for the retirement that you envision. So to schedule your complimentary retirement roadmap consultation, call 520-780-9059. It's 520-780-9059. Your retirement roadmap consultation is not going to cost you a dime. Start planning your retirement with confidence, not guesswork. Jeff, time for a break. We come back here on Premier Retirement. We've got listener questions, and later on, why rebalancing your retirement portfolio matters, when our program continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shade.
Thanks so much for including us in your weekend. You're listening to Premier Retirement with Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. My name's Jeff Shade. Glad you could join us. And 520-780-9059 is our telephone number. If you hear anything on the program today that piques your interest, you'd like to come in and sit down and talk with Jeff, get your retirement roadmap at absolutely no cost, no obligation. That number is 520-780-9059. You can make the call this weekend. Leave your name and number, Shelley will call you back during the week and get you started on that. Again, no cost and no obligation. Okay, Jeff, time for listener questions. We'll start off with Mike in Catalina Foothills. And Mike says, a longtime friend wants me to invest $10,000 in a company that claims to use AI to trade cryptocurrency. He says he's been earning 15 to 18% a month and has already made about $200,000, much of which he's been able to withdraw. The company has polished online videos and discloses that investors could lose their money. It all sounds too good to be true, and I'm worried that it could be some type of pyramid or Ponzi scheme. I can afford to lose $10,000, but I don't want to invest in something that I don't understand. What would you tell someone who's tempted by an opportunity like this?
Well, those are unrealistic returns. I mean, even when gold and silver were on their roll, I think we might have had 1 month in there like that, but continually to trade on an algorithm, you don't even really know how those algorithms work. Frankly, I don't even understand crypto, why it can even be, you make a password and call it money, and you can trade it and cash it back in for cash. Well, you're cashing it back in for cash because somebody else put cash in there to buy your, fake money. I don't even understand why it's legal. I don't understand how it even got invented other than for nefarious, illegal, underground, black market type activity and trade. So it can't be tracked supposedly, but maybe it can be tracked. I don't know. It doesn't make sense to me. The whole idea of crypto doesn't make sense to me. That's just my stance on it. Can you make money in crypto? I buy ETFs that have Bitcoin in them, and when they're on a roll up, we buy and sell them. Sometimes we make money, sometimes we lose money, but we can always cash an ETF into cash. I don't even know if the ETF has Bitcoin. That's kind of another weird, but sort of a fake way to make money, but it's a liquid way to do it. That's not a Ponzi scheme. I do know people that have claimed or have been involved. In fact, I've been involved in a couple of things I was tempted in 20 years ago or so, where it was this 5 to 10% per month type of a thing. And it was foreign currency arbitrage, they said. And then it just turned out it was a big time Ponzi scheme. And as long as you kept on giving more money, a few people could take their money out. I asked for some of my money back, but when I asked for another chunk, then all of a sudden they didn't pay it. Then pretty soon they weren't paying the 5% dividends. People were starting getting wise because everybody wanted to take profits out after a while, and they weren't raising enough money anymore. And it was found out it was a scam, and all the people were offshore in Mexico or Switzerland or someplace where they were insulated from, and because I guess there was the disclosure that you could lose all your money, they gave you the warning, so they're no longer liable. I'd be a little bit skeptical of it. If you've got millions of dollars laying around and 10,000 is no big deal, you want to throw it at it. It's just like rolling the dice at a casino, but you might end up being able to get in and get out. You also might find out that this 15 to 18% a month that your friend has earned is kind of the roll up, and now it's maybe peaking out. And now as people take profits out, there might not be any more money left. You might be getting in at the tail end of the investment window rather than at the beginning. So again, I think a lot of this stuff with crypto is much luck than anything. I have a really hard time following it or understanding why they can keep coming up with a new name on a coin and somehow raise money. There's enough people that think the emperor's new clothes are actually clothes and buy it. So that's kind of how I see it. It does sound too good to be true to me. I don't know that you always want to run. Some people say that a LIRP sounds too good to be true, even though it only makes 6 to 10% a year on average, and maybe some principal protections of tax-free income. This looks 15, 18%. That is in the realm of really too good to be true type things that are not sustainable in any investment that I've seen before. I just don't see it. I guess there's certain things. I mean, Micron for a few months did better than that. We've seen NVIDIA for a few months do better than that. But over the long haul, I think we're way behind 15, 18 a month. Now, if you start compounding that, you're looking like 300% rates of return per year on an ongoing basis. That's hard to believe that's sustainable.
Mike, thanks for the question, and certainly I would proceed with caution on that. If you'd like to have a further discussion with Jeff, 520-780-9059 is the number. Okay, Jeff, Susan is in Rancho Vistoso, and Susan says, I'm 65 and my husband Jim and I are hoping to retire in about 2 years. We've been talking about the possibility of retiring overseas, and Portugal seems to be coming up quite frequently because of the lifestyle, climate, and what we've heard about the cost of living. It sounds exciting, but it also feels like a big leap. Have you ever worked with clients who've successfully retired abroad or talked about it? What are the biggest financial, tax, healthcare, and lifestyle issues that we should think through before making this decision? And how do we know if retiring overseas is really the right move for us?
Well, I think you ought to go there and see if you can live for a month first. Maybe just go on a vacation, a summer vacation, maybe 2 or 3 months, do an Airbnb and live there. See what it looks like. Experience it first before you make that final decision. And yes, I have had some clients that have gone overseas. I have some in inquired just this week about how much could I live on when I get back if I go over there for 5 or 6 years, and just enjoy a few years of retirement. I will say that the ones that have gone to like Mexico, I've had a few go to Portugal that haven't come back yet, and they don't keep in touch with me because they've kind of turned all their money into annuities. They just get their payment, and there's really nothing to do except a little service work that Jordan handles. But nobody's returned from Portugal yet. That's kind of a new country, but the ones from South America, Central America, they all seem to do it for a year or two, or maybe 3 or 4 years, and go like, okay, man, I sold my condo. We can't do that. It's not as safe as they said it was. And I miss my grandkids, and I just kind of miss America. It's really not what it was cracked up to be. Some people, for tax reasons, go to Puerto Rico. I know people that are still trying to do that and come back only a certain amount of days per year so they don't have to pay taxes. They've done that just for the tax savings. I have heard Portugal is, high on the list because I guess cost of living is, you live in a smaller house, you live crammed up in apartment type building. You don't live in a house on a half acre an acre like you do in Tucson. You do change your lifestyle if you want to live that. They've got cheaper health care. If you've got a Medicare supplement, I guess it gives you up to $50,000 you can spend abroad if you've got a supplement. There are ways to make it. I'm a little ambivalent about it. I love America, and if you can make it in America, you should, and just travel those places and maybe live for small terms, a few months at a time, or maybe say, hey, let's go try it for a year. But I don't know. I haven't had really enough positive feedback where people say, oh my gosh, this is the greatest thing ever. You got to come. I more often see people that says, well, that was sure a fun, elongated vacation. Sure glad to be back.
Yeah, I would agree with you. We have so many assets and resources here in the United States. It's hard to imagine living in another country like Portugal or Costa Rica or someplace like that. People do try it, but you're right. I think it's better for just a very extended vacation. Susan, thanks so much for listening to us. And again, if you'd like to talk further with Jeff, 520-780-9059 is our number. Okay, Jeff, let's jump to Dave in Swarita. Dave says, I've heard you mention LIRPs, life insurance retirement plans, many times on your show. You seem to like them a lot. Specifically, what problems can they solve for, and how do they fit into my overall portfolio? By the way, I'm 65 with $1.5 million in investments, and I'm looking to retire in about 2 years.
Well, let's just put it in perspective. $1.5 million, if you leave it in the market, the rule of thumb is a 4% rule. It's really been dumbed down by Schwab and other reputable firms that says it's really somewhere between 2 and maybe 3.5. Let's just say 3%. So without running out of money, just based on volatility, the stock market investment would yield you about $40,000 a year. Let's say 45, maybe 50. Let's just push it a little bit. $1,000 a year in income would be a safe play. Plus your Social Security. Let's say if you're married, you have a spouse, maybe between you have $50,000 or $60,000. So your gross income's a little over 100. You pay tax. You pay probably $10,000 in taxes on that at a 12% tax bracket, maybe a little less, probably more like $8,000 in taxes, and you end up living on somewhere in the neighborhood of $8,000 a month. Now, the reason I like LIRP is, by the way, that keeps you in the 12% tax bracket. No big deal. That's assuming these are all retirement funds. Pre-tax would be taxable when you pull them out. What if you put a third of it in something that would generate in 2 years approximately $40,000 a year, but you'd pay taxes on it every year? And let's say over the next 5 years, you were aggressive and moved $200,000, the rest of that $1 million, into 2 tax-free bank accounts. One would be a Roth. That'll be tax-free. You'd have to pay tax on the $100,000, but you could do that with either your income, some of what you make over the next 2 years if you have some savings, and maybe even you have to pay taxes out of those gains because you don't have any money worth. Let's just say you do, just for numbers' sake. So let's say you have $500,000 over the next 5 years, probably in a Roth, and $500,000, let's say you have in a LIRP. Let's say you don't want to use the Roth, you just want to let that grow forever, tax-free, give that to your heirs and use that for discretionary income. The first $500,000 would generate $35,000 to $40,000 in taxable income, but you'd at least know what your taxable income would be. Your Social Security would be partially taxable. Let's say it's $50,000 or $60,000. Now you're up to about $90,000 taxable. The other asset would generate approximately another $35,000 in tax-free income, not touching the Roth. So you wouldn't even have to touch the other $5 million, and you'd still end up having more spendable cash. You'd be at about $125,000. Your taxes would be about $5,000. Now you're spending $120,000 a year. And the money that comes from the LIRP never even shows up on a 1099. So it never counts as provisional income. It keeps your IRMA levels way low. It keeps your tax levels way low. It keeps your taxes on your Social Security negligible, almost non-existent. In fact, you might be in a situation where in this scenario, you may pay no taxes except for the 5 years that you work the conversion program. Now, let's say you didn't work the conversion program and you took the half and half of it in a LIRP and some sort of an income play where you kept your taxable income to around 100, and let's say you had $600,000 or $700,000 in a LIRP. maybe you get $50,000 or $60,000 in income from that, plus your $30,000 or $40,000 from other investments and still be in a smaller tax bracket. What I like about the LIRP is it's flexible income. It never gets a 1099. You can tap the death benefit that is really the cost of the LIRP program. You can tap it for long-term care, move into an assisted living facility, chronic illness, terminal illness. You can actually spend your death benefit before you die. Very flexible. Most of the companies that I use, the primary companies that I use, don't charge extra for these riders or the ability to utilize your assets on a tax efficient basis or on a pre-death basis. Some companies charge rider fees, so it cuts into the performance of the tax-free growth. But some of the companies include them just because they're built for income and for retirement. I really like LIRPs. They call it the rich man's Roth. Wealthy people use it all the time. They use them in very large amounts. But you know what? Instead of having $5 million in a LIRP generating a couple $100,000 a year in tax-free cash, you can still do it with half of your savings and still generate $50,000 in tax-free cash. If you can stay out of the 22% tax bracket, stay in the 12, or the 25% bracket and stay in the 15, if the tax brackets go back to where they were before Trump changed them, which is supposed to happen, but may or may not, you have a 10% tax jump in the taxes you pay on a marginal basis. And if you're thinking about that, that's actually a 2/3, a 67% increase in the taxable amount you pay on that next $50,000 that you pull out of your IRA. The other thing is that IRA continues to grow. As you get older, they continue to tax you at a higher and higher bracket. Pretty soon you double your Medicare premiums, you double your taxes, and you're living on less. You have to scrimp and save. You have to worry about the market. I like the LIRPs just because of the safety. I like index annuities for part of that savings as well, for consistency and guaranteed income, so that you know that no matter what, if 10,000 is your lucky number, I got to live on $10,000 a year no matter what, then you need LIRPs and index annuities with income riders to guarantee that. $1.5 million won't do that by any stretch of your imagination if you use history, volatility, and what the market actually does to retirement funds while you're pulling the money out instead of putting the money in.
Dave, great question. Thank you for listening to us in Swarita. Once again, if you'd like to talk to Jeff about LIRPs, the phone number 520-780-9059. It's not going to cost you anything to do that. 520-780-9059. If you've got a question you'd like us to answer on the air, you can get it to us by calling it into Shelley if you want at 520-780-9059. You can also go to the website, which is premret.com, and leave it in the contact page there, and we look forward to hearing from you. Okay, Jeff, let's talk about why rebalancing your retirement portfolio really does matter. We spend a lot of time talking about investments people own, but today we're talking about something that often gets overlooked, rebalancing. What exactly does rebalancing a portfolio mean, and why do we want to do it on a regular basis?
We do it almost on a daily basis. What rebalancing means is, let's say you have a stock and bond portfolio, bonds are down 20% and stocks are up 20. There's a 40% disparity between a 50-50 allocation. Maybe you like 50% of your money in bonds. So what you do is you take some of the profits out of the stock and put it back into bonds. You actually buy the bonds at a lower price, hoping they go up and increase in the future. Also, you take profits out of the stock market so that if the market does correct and give back some of those profits, you've at least locked them into a safer investment. So rebalancing is good. Anytime we make a trade and add new positions to our portfolio, it typically rebalances all the old positions. If we have 20 positions in a growth fund, for example, that we manage, maybe each position is 5%. And maybe some positions go up to 7%, some positions go down to 4%. And we decide to sell 2 of our stocks that are underperforming and buy 2 more. And we just put everything back at 5%. So we rebalance on a pretty regular basis as we, manage assets, but you don't have to. Some people just like to close their eyes and let it ride, and that's fine. It's just kind of a different scenario, to each his own. But it's good to rebalance every now and then. I mean, for example, if you haven't rebalanced in a few years, 5 years ago, you had half your money in the stock market. Now you have 2/3 of your money in the stock market. Even though bonds have come up in value and the bond prices have come down, it might be smart to take profits. And it's not just stocks and bonds, but when we balance a portfolio, it is stocks and bonds. You might even want to take some of that profit off the table and move those profits. Let's say you had $1 million a few years ago. Now you got $1.5 million. The bonds have held their own, maybe gone down a little bit, but your stocks have doubled. And that's not unreasonable for the last 5 years for the stocks to double. So now you have $1.5 million. Well, maybe you still want the $1 million. You want the 50-50 split between stocks and bonds, but you take the other $500,000 in profits out and you buy an indexed annuity that gives you $40,000 a year guaranteed income and can't lose money. Or you just park it there because you don't want to lose money on that income. Or you say, you know what, I've got some gains here. Let me pull it out. Let me put it in a LIRP and never pay tax on that money again. There's all kinds of things you can do by taking profits, and rebalancing doesn't necessarily have to be rebalancing into the same original assets you have, although it would indicate, pretty much doing that. But rebalancing could also be rebalancing out of the stock market into those other things that you own. I have a client that sold some real estate, is adding to their LIRP. So they've rebalanced their real estate holdings to less real estate and more tax-free income and safety. So rebalancing also would take place as you get older or go through situations where you want to take less risk and rebalance, or basically reallocate to a more suitable risk profile. So if maybe you are now a more moderate investor where you used to be aggressive, you want to rebalance. Basically, you want to add some of that safe money. And it doesn't, again, if you're a Wall Street firm, all you do is stocks and bonds, maybe some money market or cash. We like using the other tools that are principal protected in lieu of cash because they at least have some upside if the market continues to do well, but they have no downside if it doesn't. You're not locking yourself into a low interest rate just to keep your money safe from market corrections. There's other tools to use. The Wall Street companies hate them. They're starting to talk a little bit more about them because they can't avoid them because they're losing a lot of money to them. And so some of them might even start offering them pretty soon, but typically they'll offer lousy performing ones. So you'll always want to go back into the mutual funds later. Bottom line is there's a world of financial tools out there. Most brokerage firms are limited to what they offer. Most insurance companies are limited to what they offer. Independent advisors like us are not limited because we can go to any company, any brokerage firm, and any asset provider and utilize those assets in a comprehensive plan. That's why, even though it's harder to be an independent financial advisor because you have all the overhead and all the headaches and all the hassles and startup costs and everything else that go along with it, it's tough. But once you get there, and after 40 years, I'm really glad I did it. Actually, I was glad after probably 20, but the first 20, I wasn't sure. There's more and more people are realizing that they can offer their clients more and more by becoming independent. That's why there is a lot more opportunity for you to find people that are fiduciaries like we are that can handle a more comprehensive plan and use all the tools out there rather than just go to a name brand company that tells you can only use what they offer.
Jeff, some people say that you should rebalance your portfolio once a year. Some people say that it should be once a month. What is your take on that?
Well, I alluded to it a minute ago that, every time we make a trade, we kind of rebalance what's in their portfolio anyway. We don't just let everything ride because, if things are down, we want to increase a percentage back to original and buy while it's low. If things are up, we want to take some profits. So we don't mind doing it on a more regular basis. I think when you say, we should do quarterly or annual rebalancing, that's almost kind of a cop-out for an advisor to say, well, I only want to see you once a year and we don't want to talk about your risk. We'll just see how this does for the year and go from there. And we'll just park it, hold it, and I'll golf every day and not think about it. And we'll just look at it next year when you come in for your review. And if we made money in stocks, we'll reallocate then. And that's kind of at minimum what you ought to do, I think, is rebalance it, especially according to your risk profile. But the thing is, during the year, there might be some things happen that make you want to take less risk or make you in a position where you can take more risk. Shoot, I had a guy that hasn't had a whole lot of money. He's just a super nice guy, had a few $100,000. He was able to make it on Social Security and that extra money. And then his parents passed away and now he's got $1 million. Now, he's actually in a position, even though he's never had a risk profile before, higher than safe and maybe moderate conservative, to where, I can afford to risk some of my money and see if I can make a little bit of money in the market, maybe buy a bigger house someday or whatever, or buy a new car and take some chances. So, he shouldn't have to wait till his next annual review in December. If he inherited the money in April, he had to be able to come in and reallocate when those things happen. The other things that might happen is, hey, I'm really nervous about the market. I really don't like what oil prices are going. The new Fed chair doesn't look like they're going to lower interest rates. I kind of planned on that. Maybe I ought to be taking a little bit less risk. Maybe I ought to be securing more of my stock market investments into some income. Maybe a catalyst like that makes you want to rebalance, as far as rebalance out of the stocks and bonds into other things that are maybe safer and make you feel a little bit more secure about your retirement. So again, rebalance as often as you want to. When it comes to the managed portion of our assets, we're always rebalancing, keeping the proportions in check with what your risk profile says it is. But if things along the way change, you need to schedule a visit with your advisor, come in and talk, and we can change that allocation. We can rebalance into things outside of the market if you want to, and just readjust your income plan according to your needs, according to the new scenario that you find yourself in, and according to your risk tolerance or just what you're feeling any given day.
Jeff, should market headlines ever change that schedule on rebalancing?
Well, yeah, I was kind of alluding to it a minute ago, that market headlines might, if you find yourself uneasy about the market in the present situation and you think, man, I don't know if I can sleep at night if I'm keeping my money in aggressive investments, I need to dial it back. And I've had people tell me that recently. I mean, just, in the last few months that have said, you know what, I just don't like what I'm seeing. I'm going to change my philosophy a little bit. Or, hey, I thought I was going to have more money on gold and silver, but it's softening up and oil's getting better. Maybe I ought to go back into the market a little bit and take some profits on some of this precious metal stuff. Or, hey, the precious metals are down. I want more. Can we reallocate into that? I mean, you might have some things that float your boat. Now, I'm not necessarily opposed to having more or less in precious metals than somebody else wants if that's your goals and it doesn't screw up your plan, or if having hard assets that are hard to get out of, gold, silver in a safe, make you feel comfortable, then allocate, buy more if you want to, if it doesn't disrupt your plan or the guaranteed income that you need to live on a monthly basis and an annual basis, then do that. But our phone's always ringing. Our door is always open. You can come in and talk with us anytime that you have something come up that concerns you, whether it be on the news or just a family emergency or a situation that's changed or a health crisis or just an epiphany on what you want to do or accomplish in retirement. It's always worth an update meeting. Don't wait till your annual meeting just to tell your advisor what you thought of 6 months ago. Schedule an appointment. Come and talk. We always welcome that.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. And again, Jeff invited you to give him a call. The phone number, 520-780-9059, 520-780-9059. When was the last time that someone reviewed your portfolio to see whether or not it's still aligned with your goals, not just performing well, but actually positioned to support the retirement that you want? Well, Jeff and the team here at Premier Retirement Planning and Wealth Management are offering a complimentary Premier Retirement Roadmap for you. They'll evaluate your current allocation, identify areas where your portfolio may have drifted, and discuss tax-efficient strategies, income planning, and help determine whether you're taking the right amount of risk. Not too much and not too little. So call us here at Premier Retirement, 520-780-9059. To schedule your complimentary retirement roadmap, it's 520-780-9059. You can also find out more about us online at premret.com. Jeff, out of time for this week. I want to thank you for your time, but most importantly, as I do every week, I want to thank our great listeners here in the greater Tucson area for joining us. So for Jeff Vogan, I'm Jeff Shade, wishing you a great weekend. Be sure to join us again next week right here for another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.